Hi, welcome to the exciting Globe Labs. In this video, we're going to talk about US economy, as they have been gaining massive attention lately. So today, we investigated further on this topic and will be discussing the deep story. Make sure to watch all the way to the end of this video because this story will absolutely be shocking and astonishing. So without further ado, let's dive right in. And before we start, smash that subscribe button for more videos like this in the future. Now here we go. Here is Silicon Valley, which is located roughly halfway between San Jose and San Francisco. That is the global center for technological innovation and the industries that support it. The general Silicon Valley metropolitan area has the world's third highest GDP per capita, trailing only Zurich in Switzerland and Oslo in Norway, both of which are significantly smaller economic regions. Overall, this otherwise unremarkable stretch of land, approximately 50 kilometers long and 25 kilometers wide, generates more economic output than the majority of the world's countries. This is due to the institutions that operate there, which range from the world's most valuable company to startups operating out of converted garages, as well as investment funds and universities. Yes, the banks that enable and encourage the innovation that propels this region. Obviously, you already know which of these groups is making headlines because we took our time making this video. 2 weeks ago, Silicon Valley Bank, one of the most important financial intermediaries in one of the world's most important industrial centers, failed, and depositors were literally lining up outside the bank stores, scenes that most economists assumed had been relegated to the history books. Within the same week, another two banks, Signature and Silvergate, also failed, putting immense pressure on other banks such as Credit Suisse and First Republic, which have since reopened. Even in isolation, a large bank failure is a serious problem for the economy. However, 3 bank failures in such a short period of time, especially ones as large as SVB and Signature Bank, has always meant a recession or depression. The Jane Coke Company Bank, a forerunner of new technologies such as telegraph messaging to confirm transactions, went bankrupt in 1873 after failing to sell enough railroad bonds quickly enough to cover withdrawals. The bank failure triggered other bank runs and triggered the Great Depression of 1873, which lasted until 1893, when new investments in novel assets such as farmland in Argentina and properties in Australia fell in price, leaving the banks facilitating and encouraging these purchasers vulnerable to bank runs. And a severe economic downturn that affected every sector of the economy. The fallout was so severe in the United States that it resulted in widespread cultural changes throughout the country. The process is now known as political realignment. In 1907, a lack of trust among depositors during a difficult period of economic uncertainty, exacerbated by new and unregulated investments, resulted in numerous bank runs and a sharp drop in financial markets. The 1929 Great Depression, the real one this time, was caused by an economic contagion that began with a sharp drop in the stock market, leading to bank runs that rippled through the economy, forcing industry to grind to a halt. Savings and loans associations, which were effectively just another type of bank focusing on consumer savings and consumer loans, were established in 1986. As a result of rising interest rates required to combat inflation, their business model was called into question. Bank failures exacerbated an already difficult situation. Economic Times, 2008, put pressure on banks that facilitated and encouraged new types of investment. When the value of those investments fell, the market panic eventually resulted in the single largest bank failure in U.S. history, Washington Mutual, and kicked off the economic recession that we are still feeling the effects of to this day. The economy was in a precarious position. Banks that used new technology to encourage and facilitate investments in new and unique assets began to fail as depositors became concerned about their solvency in the current high interest rate and high inflation environment. So far, the total value of bank failures is roughly equivalent to the first year of the GFC, with many economists and commentators predicting that this is just the beginning and that many other banks around the world will face similar pressures in the coming months. So, in order to understand what this means for the broader economy this time, we must first answer a few key questions. What is causing the most recent bank failures? Why couldn't the government or the Fed stop it? Are more bank failures on the way? Finally, will these bank failures cause broader economic problems, as they have in the past? For starters, the 2023 bank failures have all had a few things in common. All of the banks were providing financial services to niche markets rather than everyday consumers. Silvergate and Signature conducted a significant amount of business with cryptocurrency exchanges and investors. And Silicon Valley Bank focused on the types of businesses that make Silicon Valley the global center of innovation. Banks also had extremely large account sizes. As of 2019, the average bank account size in the United States was $41,600. It's probably a little higher now, thanks to pandemic-era savings, but this is an average. As a result, it's heavily skewed due to the massive accounts held by corporations and extremely wealthy individuals. The median account balance, defined as the account in the exact middle of a group of accounts lined up from largest to smallest, was $5,300. Silicon Valley Bank's average account balance was over $1 million, and many of their services were not even available to people or businesses with less than that amount. Some of the bank's most important depositors had tens of millions, if not hundreds of millions, of dollars in their accounts. Signature Bank, Silvergate Bank, and other banks shook by the market panic, such as Credit Suisse, have very large average account sizes because they attract large corporations and wealthy individuals. The problem for banks is that their depositors' money is mostly not covered by the FDIC, which only guarantees the first $250,000. Kept with the bank for the average person with a $5,300 account balance. This guarantee is sufficient to ensure that they do not have to worry about their bank failing because all of their money will be protected. And the worst that could happen to them is a minor inconvenience while their lost funds are reimbursed. This guarantee rendered Great Depression-era bank runs obsolete, as there is no longer a need for regular people to withdraw their money in order to keep it safe. The FDIC, in fact, was established in 1934 in response to the economic problems caused by bank failures during the Great Depression. However, the majority of bank accounts are not covered by this limit. It reintroduces the risk of bank runs. The solution would simply be to remove the limit. That way, any amount of money would be covered, which means that even very wealthy account holders would have no need to rush their money out of a bank, which could make it less likely that the FDIC or other institutions in other countries would ever have to pay out while making this video. According to a financial regulation professor at HEC Paris and a former economics policy advisor for the European Central Bank, about the challenges of introducing limitless coverage to bank accounts. So, in theory, there is a trade-off when it comes to deposit insurance. As a result, this has always been a trade-off. On the one hand, you could argue that if deposits are uninsured, there will be a lot of bank hands because depositors will react very strongly each time they see a signal that the bank isn't doing so well. As a result, they caused numerous banking panics, such as in the early 1930s in the United States. That is why the FDIC was established at the same time. If you insure all depositors, even large and sophisticated ones, this becomes a problem because the bank now has a lot of liabilities, all of which are insured. So you've built a strange company with a lot of leverage. Many creditors, and these creditors are insured by someone else. So they no longer care about the risk that the bank is taking. In this case, the FDIC made the decision in a joint statement with the Treasury and the Federal Reserve to offer unlimited coverage given the circumstances, and their wording made it clear that they would continue to do so for any other bank failures that may occur in the near future. People were irritated because this was yet another bank bailout that would eventually be paid for by taxpayers, which is not entirely true but also not entirely incorrect. The Federal Deposit Insurance Corporation is an insurance company. It does not receive funding from taxpayers. Because of the large payout, it charges banks and other deposit-taking institutions for insurance. The FDIC will raise the amount of money it charges all other banks for its protection. And those additional fees will be passed on to bank customers in the form of higher fees, lower interest rates on savings, or higher interest rates on loans. Many people are concerned that now that the banks are insured by the FDIC, they will continue to make more money and take more risks in the future, knowing that they will always be too big to fail. Concerns are understandable, but in this case, they are simply incorrect. The shareholders in all of these banks, who ultimately made decisions about how the banks are run, were wiped out. Only those who kept their money with these banks and had no involvement in their operations received their money back. As a result, this does not convey the message that this is a good way to run a profitable bank. There is certainly an argument for moral hazard issues in the banking sector, but this is not an example of letting them fail. While the FDIC has stepped up to ensure that no one rushes to withdraw their money from any more banks by ensuring that everyone is covered in theory, it should never have gotten to this point because it is the Fed's job to ensure that this never happens. Silicon Valley Bank's assets were sufficient to cover its deposits. It was actually holding the majority of its assets in the form of government treasury bills, which are theoretically the safest investment that anyone can make. The issue was, as you're probably aware, that their value has an inverse relationship with short-term interest rates. So they bought these bonds when interest rates were low and tried to sell them when rates were high in order to free up enough cash to cover an unprecedented number of withdrawals. This was the bank's failure. Even if the assets themselves were very safe, they should have known that covering interest-bearing accounts with interest-bearing assets was a huge risk. Now, if the bank invests heavily in treasuries, when interest rates rise at the same time, the value of these treasuries will fall, which is normal. At the same time, depositors on the liability side will continue to demand higher and higher interest rates. At some point in time. Actually, the bank with only treasuries may fail because the interest it must pay to depositors is greater than the revenue it receives from treasuries. The bank, by the way, still had assets, it was simply forced to sell them at the wrong time. In these cases, the Federal Reserve Bank is supposed to act as a lender of last resort. That is literally why the institution was founded. If a bank runs into trouble and doesn't have enough cash on hand to cover withdrawals, it can go to the central bank for a short-term loan to pay the people trying to withdraw money. The central bank does this because it knows that if just one person is unable to withdraw their deposits from a bank on demand, it could spark a panic, resulting in bank runs on multiple banks and stressing the entire financial system. So why didn't they do that in this case? So far, the answer is not entirely clear. It could be because the run happened so quickly that the Fed and SVB didn't have time to arrange emergency liquidity, or it could be because the Fed decided the bank was doomed regardless and that giving them emergency loans would be a waste of money. The catch is that lending to us results is supposed to mean that you lend to solvent banks, and they'll just be illiquid. Okay, but the reality is that it is extremely rare to find banks in perfect condition. Their solvency is not in doubt, and only people go completely insane and run on the bank. This week, as fears of bank failure spread around the world, Credit Suisse was allowed to borrow $54 billion from the Swiss central bank to ensure its liquidity. So, either Switzerland reacted faster, the much larger Credit Suisse was seen as a safer bet, or it was just so important to the finance-focused Swiss economy that it got everything it needed regardless, whereas SVB was slightly more expendable to the much larger and more diverse economy of the United States. Now, despite the banking system's loss of stability and the loss of confidence that many people have in it, many economists are unconcerned about the recent bank failures. Despite the fact that in the past, they have almost always meant the end of the broader economy. So, do banks no longer matter? Banks play an important role in the economy, but they are less important today than they have been in the past. One of their most important functions is simply providing a place for people to keep their money so that it cannot be stolen or lost in an event such as a house fire. Money kept in a bank account is also easier to spend when combined with modern technology such as credit cards and electronic payments. This contributes to an increase in what economists refer to as the velocity of money, or how quickly money changes hands. If people spend their money more quickly, it can flow through more businesses and create more jobs, which, all else being equal, is an ideal outcome. Banks also play an important role in lending money to individuals and businesses. This increases the amount of money in the economy. In the case of businesses, it can help build companies that lack the necessary capital to get started. But once they do, they can add value to the economy and create jobs, if that wasn't already important to the economy's functioning. Banks can combine their roles as deposit takers and loan makers to perform a cool trick known as the money multiplier. If someone deposits $10,000 into their bank and that bank only has a 10% reserve requirement, that means they can lend out $9,000 to someone else who will spend that money at a business and then deposit that money into their bank account. And then their bank can loan out $8,100 until $100,000 is created in the banking system from just that initial $10,000. That is a pretty impressive trick, beautifully illustrated by one of my favorite YouTube creators. They made a video about the recent bank collapses, but it's also incorrect. Bank deposits are not loaned out in the banking system, at least not in the United States and most other advanced economies. They are kept in what is known as the interbank system and are only traded between banks. Banks do not require your deposits. They only need to deposit money into an account. And the only constraint on them doing so is not the amount of money they have from depositors. It is the amount of demand they have from borrowers who meet their lending criteria as well as the lending criteria of government agencies. A good example is Silicon Valley Bank. Because it didn't have enough customers to responsibly lend to, it allocated the majority of its funds to low-yielding government treasury bonds. It would have preferred to make loans with higher interest rates than the less than 1% yield on treasuries. However, in the real economy, there isn't an endless line of qualified borrowers waiting for a loan. The money multiplier myth is so widespread that the Fed had to issue a paper to convince economics teachers in schools and universities that a bank's true role is something called maturity transformation. Depositors will leave money in their bank accounts, but they will never know when they will need it. As a result, the time horizon of that capital allocation is unknown. Banks can use this type of short-term capital as the basis for long-term loans in projects that will take a long time to pay off. Last year's Nobel Prize winners were recognized for their work in clarifying the role of financial intermediaries, but they are no longer the only institutions making these types of capital allocations. Growing inequality has resulted in money being held in the hands of very wealthy people who have far more capital than they will ever need on a daily basis. This means they don't need to keep the majority of their money in a bank account. They can keep some to cover expenses, but the majority will be invested directly rather than indirectly through a bank. Businesses looking to get started used to go out and get a loan from a bank. However, responsible lending to new businesses is becoming increasingly difficult because regulations want to ensure that the loan is repaid, and most new businesses fail. As a result, today, a large portion of business funding is provided by investment firms, which raise funds from a growing number of extremely wealthy individuals looking to invest. I believe the business model of banks in general, as well as the case for banks engaging in a lot of financial intimidation. This case, I believe, is weakening over time. And the fundamental business model of banks is less clear today than it once was. So, it used to be that monetary transformation was such an important part of the economy that most savings were in the form of small retail deposits. And you intended to use your savings to finance businesses. So you basically needed banks now that we have much more economic inequality. So, maybe richer people can just invest in funds, and those funds will finance the companies. As a result, there is much less opportunity for, collecting small deposits in order to finance new businesses. So that's a possibility. Perhaps the role of banks in this transformation is less important today than it was previously. Historically, this was a good idea because you needed a one-stop shop, a single bank advisor who could do everything. With the internet, you can now divide banking services into many different subcomponents. As a result, you may not need to use the same bank for everything. You could have someone doing your investment, borrowing from someone, taking your deposits, and so on and so forth, or this could be done by fintech, your bank, and so on. As a result, there could be numerous intermediaries. So I believe there are numerous reasons why society should rely less on banks today than it did previously for the economic system as a whole. This is not a good trend, but it does indicate that what we are seeing today is most likely bank failures as a result of poor economic conditions, rather than bank failures as a result of poor economic conditions. Did you enjoy this story? If you did, don't forget to hit that like button and subscribe to this channel for more videos like this in the future. Also, be sure to turn on the bell notification so you never miss any of our videos. So, what do you think about this topic? Did you enjoy this topic? Let us know what you think in the comment section down below. See you in the next video. Thanks for watching.